Gold is supposed to be a safe haven. You need a safe haven when there's war. When it's peace, you don't need the safe haven anymore, right? There's nothing that you need safety from because the hostilities are ending. But everything is keying off the Fed. Everything. And it shows you that the Fed just has way too much power in the economy or in the financial markets, because the reason that gold is rallying and the reason that stocks are rallying and the reason that foreign currencies are rallying and the reason that Bitcoin is rallying is not because there's not going to be a war. It's going to be because the markets believe that peace means we'll have rate cuts.
Gold's recent rally is being driven more by expectations of monetary easing than by geopolitical risk. While the market has traditionally been a safe haven during conflict, it is reacting to the belief that easing tensions could lead to Federal Reserve rate cuts. This shift is lifting not just gold, but also equities, currencies, and even Bitcoin, signaling that liquidity expectations, not fear, are driving price action. It highlights how deeply financial markets are now tied to central bank policy. PeterSchiff, a longtime critic of fiat systems, argues that this reflects an environment in which monetary policy dominates all asset classes. If rate cuts materialize, gold could continue moving higher, not because risk disappears, but because lower rates weaken the dollar and boost demand for hard assets. The broader implication is that gold may remain in an upward trend, supported by expectations of ongoing monetary easing and currency debasement. Now, we present the clips from PeterSchiff's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
So I want to, talk a little bit again about the markets and, really the counterintuitive movements in the gold market, because gold rallies on war and, rallies on peace and sells off on war. Right? Whenever there's an escalation in the rhetoric, this war is going to get worse, gold goes down. But when we have a situation today, it gets de-escalated, there's a ceasefire, gold goes way up. That is the opposite of what you would expect. If gold is supposed to be a safe haven, you need a safe haven when there's war. When it's peace, you don't need the safe haven anymore, right? There's nothing that you need safety from because the hostilities are ending. But everything is keying off the Fed. Everything. And it shows you that the Fed just has way too much power in the economy or in the financial markets, because the reason that gold is rallying and the reason that stocks are rallying and the reason that foreign currencies are rallying and the reason that Bitcoin is rallying is not because there's not going to be a war. It's going to be because the markets believe that peace means we'll have rate cuts. That the one thing standing between the markets and the rate cuts is the war. Because the war keeps the price of oil up, and that keeps pressure on consumer prices, and that takes the rate cuts off the table. But the view is that if the war is over, oil prices will come back down, and that means the inflation threat diminishes, and that allows the Fed cover to cut rates. And so it's all about rates. Nobody really cares about the war. It's about interest rates. But what all of these traders still don't get is that the rate cuts are not what's important. What's important is where are interest rates relative to inflation. Doesn't matter if the Fed cuts or hikes. If inflation moves up more than the Fed hikes rates, or the Fed doesn't hike rates at all, and inflation moves up, you're getting a reduction in the real rate of interest. And that's bullish for gold. And it's not oil prices going up that are inflationary. They're not. Higher oil prices means higher oil prices. Doesn't mean higher inflation. All else being equal, if the price of oil goes up, the price of other things are going to come down. Because if I have to spend more money on energy, I have less money to spend on something else. And so demand for other things goes down. And that means the price of other things will go down. Now, that's not good news. I don't want to spend more money on energy. I want to have more money left over for other things. So my standard of living goes down if I have to pay a lot more for energy, but that doesn't mean there's more inflation. The only reason that we can pay more for everything is because the Fed creates the inflation. The Fed creates additional money so that I can buy oil and still have money left over to buy other stuff. So it's the inflation of the money supply, the Fed accommodation, that allows inflation to rise, not the increase in oil prices. But again, nobody seems to get that. They just focus on prices, and they see oil prices, and they think that this is going to be the limiting factor. It's not. But even though inflation is going to be a lot higher, not because oil prices are higher, but because the Fed prints more money, the Fed is going to ignore that inflation, and they're going to cut rates anyway. In fact, even though this war may be over, who the hell knows, but whenever it does end, oil prices are not going back down to $60 a barrel. I doubt they'll even get much below $80 a barrel, and they won't stay there. I think oil prices are going to be significantly higher as a result of this war. Donald Trump talks about how he expects the price to come collapsing down when the war is over. I don't think so. I think that you're going to have more countries that need to stockpile strategic reserves. I think that the risk premium is going to be forever elevated, that who the hell knows, based on any kind of agreement that the United States comes to with Iran. I don't know how anybody can have any confidence that that agreement is going to hold, or that Trump is going to somehow be bound by whatever he signs, because I don't think he is. Remember, he told the New York Times, Donald Trump, he was asked, what are the limits on your power? And this is back when he was talking about taking over Greenland. And Trump said, there are no limits on my power as commander in chief. I can do whatever I want. He said, the only limitation is my own mind, my own morality. So he doesn't recognize any other authority. He doesn't recognize the Constitution as restraining him. He doesn't recognize, international law, conventions, I mentioned, treaties about, not targeting civilians. And I don't think he's going to feel bound by any treaty that he signs. I mean, look, he wasn't, he talked about how great NAFTA was, and then he wanted to violate, not NAFTA, but USMCA, right? NAFTA was the horrible, worst trade deal ever. And then when we got to USMCA, which was pretty much NAFTA rebranded, Trump said that's the greatest trade deal ever. But then he didn't want to abide by that when he started slapping all these tariffs on. Screw USMCA. So the world is not going to necessarily believe that any kind of truce, any kind of ceasefire, peace deal is permanent. So everybody is going to have to be prepared. We'll hope that the situation doesn't flare up again, but we better prepare. We don't want to be caught off guard. And so it's gonna put a premium in the oil market. Prices are not going back down. Obviously, we already had an inflation problem. Prices were rising for just about everything except oil. That was the one bright spot that we had. Everything was getting more expensive, but oil was cheaper. Well, now everything's going to be more expensive, and oil. Oil's going to be going up too. And the economy is going to continue to weaken.
To further illustrate this, gold's recent price action reflects a major shift in market behavior, where movements are driven more by interest rate expectations than by geopolitical risk. Instead of rising during conflict, gold has been falling on escalation and rallying on de-escalation as markets focus on the likelihood of rate cuts. When tensions ease, investors anticipate lower interest rates, which lifts not only gold, but also stocks, currencies, and other risk assets. Looking deeper, the relationship between interest rates and inflation is the underlying driver. Even if central banks adjust rates, the key factor is whether inflation is rising faster than those adjustments, pushing real yields lower. This environment tends to support gold over time, At the same time, elevated energy costs and ongoing monetary expansion suggest inflation pressures may persist, keeping real rates under pressure. Therefore, the broader outlook indicates that gold could continue trending higher, not because of peace or war itself, but due to the long-term erosion of currency value and sustained monetary easing. Let's get back to the interview.
Donald Trump is saying we have the greatest economy in history. Not just the greatest economy recently, not just a better economy than we had under Biden, but we have the greatest economy in history. At the same time, he says that under Biden, we had the worst economy in history. We had a dead economy, and now we're the hottest economy in the world. Now, the independent voters who are being polled, they were alive when Biden was president. So they lived through the worst economy in the history of the world. And now they are living in the greatest economy in the history of the world. Wouldn't you think that they would give Trump credit for that? Wouldn't you think he would have high approval ratings if in such a short period of time, Trump was able to take us from the worst economy in history to the greatest economy in history? Yet the people who lived through both are not happy about that. They're not excited. Gee, yeah, I'm glad that Donald Trump brought us, from the brink of annihilation there. It was so miserable under Biden, and now this is an economic boom. Obviously, if the people are saying that the economy is worse now than it was under Biden, what does that say? Because if we had the worst economy in history under Biden and now it's worse, what does that mean about Trump? Now we have the worst economy in history, right? If Trump was accurate about his description of the Biden economy. So this to me is a much more important indicator. Forget about these government numbers. They're all fudged, right? They've been reverse engineered and they're designed deliberately to deceive. But when you ask people how they're doing and they tell you I'm doing awful, that's more believable. And the Fed is going to be under intense pressure to cut rates, regardless of inflation. And the Fed will excuse it. They'll attribute it to temporary, transient factors. They'll attribute it to the lingering effects of the war, the lingering effects of tariffs. They are going to focus on weakness in the economy and weakness in the labor markets. And both are going to be even weaker in the aftermath of this war. And whatever kind of peace we end up negotiating to bring an end to it, if it does end. So I think we're going to get the cuts. I think the markets are right in that. But I would not be buying into the U.S. stock market. I think the U.S. stock market, after this big rally, I think it could roll over. I mean, Dow's up almost 1,000 points now. The Dow was way overpriced before the war started, and it didn't even go down that much during the war. There's still much too much optimism out there and complacency for a very overvalued U.S. stock market. But that does not mean that you should be sitting in cash. You should not be. Because as overvalued as the U.S. stock market is, the U.S. dollar is every bit as overvalued. And the dollar is going to go down. And that means if you're sitting in cash and your cash is dollars, you're losing purchasing power. So instead of owning dollars, you want to own gold and silver. You want to go over to Schiff Gold and buy some gold and silver. You want to open up a T-Gold account if you don't already have one and get yourself some T-Gold in addition to the physical gold and silver that you take delivery of. And move more money out of U.S. stocks. This rally, I don't believe, is going to last, but I think emerging markets are going to emerge from this in much better shape. I think foreign markets are going to be in better shape because I think money is going to continue to flow away from the U.S. dollar, away from the U.S. bond market, away from the U.S. stock market, and that money is going to come back to where it came from. And this is a huge wave that you want to ride it. You don't want to get crushed by it. You want to ride it for as long as you can. Most people have no idea that this is what's happening. So there'll be some euphoria. I would sell into the rally in U.S. stocks, but I'd keep buying into gold and silver, buying into foreign stocks, buying into the mining stocks. We mentioned I have a For the first time, I've got a sponsor, West Red Lake Mining, and they just did a commercial. First time I've done that. And I thought it was interesting because I'd owned that stock for some time. And they approached me about sponsoring the podcast. And I was like, well, yeah, a lot of times I get approached by financial companies and I turn them down because I guess I don't want to recommend them. But here was something I already owned it. And I said, well, yeah, I see gold companies advertising. They advertise on television. I turn on financial news and you see gold companies run advertisement. They have investor relations. So why not have a company? Maybe I'll get more companies sponsoring my podcast as long as I like the stock, because I think people should be buying gold mining companies. I think this is going to be a huge boom. You can either buy individual stocks on your own, or you can buy into my mutual funds. You can buy into my separately managed accounts. Have us manage the portfolios for you in gold stocks. But they had a pretty big pullback, and the war was the catalyst for the pullback. Even though the war should have been bullish, it was the catalyst for a shakeout. But we have set the stage for the next leg up. And I do expect the mining stocks to lead the metal. I think the GDX, the GDXJ, which are not the best way to buy, but as an indicator, a benchmark, I believe those mining stocks will make new highs for this move. They will take out their February highs before gold and silver take out their highs. And I think that's a healthier bull market. And I am very well positioned to benefit from that. And again, I would encourage all of our listeners to this podcast to try to use this pullback. I've been recommending the entire time the market was under pressure to increase positions. And I would continue to advocate for that. This was a gift. And even though the markets will be up a lot tomorrow, and maybe buying the open isn't the greatest move, I'd maybe wait for a pullback. But the markets are still significantly lower than where they were. Even if we have a huge gain tomorrow, we're still significantly lower. We're still more than 20% below the peak. So it's a great opportunity to buy back in.
Transitioning to the broader economy, the current economic narrative is increasingly diverging from lived reality, with official data suggesting strength while public sentiment reflects growing financial strain. This disconnect is shaping expectations for monetary policy, as weakening consumer conditions and labor markets are likely to push central banks toward rate cuts, regardless of persistent inflation pressures. Markets are already pricing in this shift, fueling rallies across multiple asset classes, but underlying imbalances remain unresolved. What emerges from this setup is a potential transition phase in which capital may begin to rotate out of overvalued domestic assets. As a result, the outlook suggests continued pressure on the dollar as purchasing power erodes, while global capital seeks opportunities elsewhere. Consequently, precious metals and mining equities appear positioned to benefit from this shift, particularly if real interest rates continue to decline. Meanwhile, equity markets may face renewed downside risk after recent gains, as optimism fades and structural weaknesses reassert themselves. The broader implication is a changing financial landscape, making diversification into hard assets and international markets increasingly relevant. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.